It begins with a chilling announcement from the government. The United States formally suspends free speech protections under the First Amendment, citing national security, public order, or societal stability. For centuries, freedom of expression has been a cornerstone of American democracy, fueling debate, innovation, and social progress. Its abrupt removal sets in motion an unprecedented transformation of economic, corporate, and social structures. Citizens, corporations, investors, and global observers react with a mixture of shock, fear, and uncertainty as the foundations of American society, long assumed immutable, are suddenly questioned. The immediate effect is on corporate communications. Publicly traded companies accustomed to transparency and open discourse must now navigate new restrictions. Investor relations, earnings calls, press releases, and corporate social responsibility announcements become tightly monitored and potentially censored. Stock markets react with heightened volatility as investors struggle to anticipate the impact of restricted information flow on corporate governance and operational transparency. Innovation faces an immediate constraint. In an environment where ideas can no longer be freely expressed or challenged, research and development slow. Startups, creative industries, and technology firms experience internal caution as employees fear legal or social repercussions for expressing unconventional ideas. Stock valuations for high innovation sectors, technology, biotechnology, entertainment, and media decline as investor confidence in sustained growth diminishes. Consumer confidence becomes fragile. Citizens aware of restrictions on expression begin altering behavior, prioritizing conformity and risk aversion. Consumer spending patterns shift toward essentials and away from discretionary goods perceived as potentially controversial. Stock markets for retail, entertainment, and cultural sectors face downward pressure as purchasing decisions are influenced by social and legal constraints. Labor markets are affected profoundly. Employees in journalism, academia, law, and creative industries face uncertainty and fear, leading to talent attrition, brain drain, and decreased productivity. Stock markets for firms in media, education, and professional services reflect reduced growth potential and operational risk. Corporate governance undergoes rapid transformation. Boards and executives navigate regulatory oversight in a high-risk communication environment. Strategic decision-making becomes conservative, with companies avoiding controversial markets, products, or messaging. Stock markets react to perceived risk aversion, with high-growth, market-disruptive firms losing relative valuation. Financial markets are immediately sensitive to information flow constraints. Investors rely on accurate, timely data for decision-making. Restrictions on speech and disclosure create opacity. Stock prices fluctuate sharply as market participants struggle to evaluate corporate performance, regulatory compliance, and risk exposure. Hedge funds, institutional investors, and day traders adapt with increased caution, adjusting portfolio allocations to sectors perceived as low risk under a speech-restricted regime. Entrepreneurship suffers. Small businesses and startups, historically reliant on open idea exchange, peer feedback, and social validation, confront new barriers. Venture capital and private equity firms adjust funding strategies, favoring established firms and sectors less exposed to public scrutiny or regulatory backlash. Stock markets reflect this shift, with reduced enthusiasm for early-stage, high-risk innovation. Advertising, marketing, and media industries experience disruption. Restrictions on speech limit messaging, creative content, and campaigns. Social media platforms, streaming services, and broadcast networks face compliance challenges, while consumer engagement declines. Stock valuations for media, advertising, and entertainment firms fluctuate as uncertainty grows. Global trade perceptions shift. International partners, investors, and corporations question U.S. stability, transparency, and governance. Trade negotiations, foreign direct investment, and multinational operations are impacted by the perceived risk of operating within a speech-restricted environment. Stock markets for multinational firms adjust, based on exposure to geopolitical and reputational risks. Financial institutions adapt compliance, monitoring, and reporting protocols. Banks, insurers, and asset managers face heightened scrutiny as speech restrictions influence transparency, regulatory adherence, and market behavior. Stock valuations for financial firms reflect both opportunity and risk management services and exposure to regulatory volatility. Consumer technology adoption evolves under caution. Platforms for social networking, content creation, and digital communication face regulation, censorship, or self-imposed limitations. Stock valuations for tech firms involved in AI moderation, cybersecurity, and digital content monitoring rise, while open platform providers experience decline. Corporate mergers, acquisitions, and strategic partnerships are influenced by regulatory constraints. Companies consolidate or restructure to mitigate reputational and operational risk under speech restrictions. Stock markets reflect selective growth opportunities for firms navigating the new regulatory landscape effectively. Labor market mobility slows. Professionals in creative, academic, legal, and media sectors hesitate to relocate or switch employment due to speech-related legal risks. Talent concentration shifts towards sectors perceived as safe, influencing wage dynamics and company performance. Stock valuations for firms relying on specialized labor adjust accordingly. Investor behavior undergoes transformation. Risk appetite diminishes in sectors vulnerable to legal, reputational, or regulatory backlash. Defensive investments, essential service sectors, and compliance-focused industries see increased capital inflows. Stock markets experience sector-specific divergence, with high-growth, high-innovation firms underperforming relative to stability-focused sectors. Corporate strategy increasingly emphasizes risk avoidance, regulatory compliance, and operational predictability. Firms reduce experimentation, limit controversial product launches, and minimize public commentary. Stock markets reward companies demonstrating resilience, transparency, and compliance while penalizing aggressive or disruptive competitors. Supply chain dynamics are indirectly impacted. Global suppliers and partners adjust engagement strategies, preferring jurisdictions with predictable communication and regulatory environments. Stock valuations for multinational supply chain firms reflect potential operational risk and reputational exposure. Household behavior and economic confidence evolve. Citizens limit public expression, participation in civic discourse, and engagement in cultural or political discussions. Consumer spending in socially expressive sectors declines, impacting retail, entertainment, and media company revenues. Stock markets adjust accordingly. Corporate debt markets face elevated scrutiny. Lenders and bond investors assess risk associated with governance opacity, restricted reporting, and potential compliance violations. Stock prices for financial institutions reflect these adjustments, while corporate borrowers navigate higher cost of capital environments. Educational institutions confront challenges. Academic freedom and research transparency are curtailed, reducing the flow of knowledge, peer review, and innovation. Stock markets for education technology providers, university service firms, and publishing houses reflect reduced growth prospects. Healthcare and pharmaceutical sectors adjust to communication restrictions. Public health messaging, research reporting, and corporate communications face scrutiny. Stock valuations for medical device firms, hospitals, and biotech companies reflect increased regulatory risk alongside operational opportunity. Global investor perceptions are volatile. Sovereign risk ratings, credit assessments, and international investor confidence are influenced by limitations on speech. Stock markets for U.S. multinational corporations and globally integrated financial institutions fluctuate in response to shifting global sentiment. Corporate innovation slows markedly. Research and development investment becomes conservative, while disruptive technologies and experimental ventures decline. Stock valuations for tech startups, biotech firms, and innovation-driven companies experience sustained downward pressure. Advertising, public relations, and branding strategies are redefined. Firms shift toward neutral, compliant messaging, avoiding controversy or regulatory scrutiny. Stock markets for creative service providers reflect adaptation opportunities for compliance-focused innovation. Consumer culture evolves under caution. Social expression, cultural commentary, and political engagement are subdued. Industries dependent on open communication, media engagement, and public discourse experience reduced revenue growth. Stock market valuations for these sectors decline relative to essential goods and services. Corporate risk management gains prominence. Legal, regulatory, and reputational oversight becomes central to governance. Stock markets reward firms with effective compliance frameworks, transparency, and proactive risk mitigation. Government policy and regulatory oversight intensify. Agencies enforce speech-related rules, monitor corporate communications, and implement penalties for non-compliance. Stock markets for government contractors, compliance technology firms, and advisory services experience growth. Consumer credit and household financial behavior are influenced indirectly. Cautious spending, reduced social engagement, and perception of risk alter borrowing and investment patterns. Stock valuations for banks, credit providers, and wealth management firms adjust to shifting consumer priorities. Corporate mergers and acquisitions are increasingly strategic. Firms consolidate to gain operational resilience, legal protection, and market stability in a restrictive speech environment. Stock market reactions favor consolidation in regulated or essential sectors. Energy, manufacturing, and industrial sectors adjust communications and operational disclosures to comply with restrictions. Stock markets respond to companies demonstrating risk-averse operational governance. Global financial interconnections are affected. Investor confidence, foreign capital inflows, and multinational operations are influenced by perceived U.S. governance and transparency risk. Stock markets for globally exposed firms reflect this uncertainty. Household economic behavior focuses on essential consumption, security, and stability. Retail, leisure, and discretionary sectors experience slower growth, while consumer staples, utilities, and essential services benefit from predictable demand. Stock markets adjust accordingly. Corporate transparency and governance become pivotal in investor evaluation. Firms demonstrating accountability, regulatory compliance, and operational clarity outperform peers. Stock markets reward strategic foresight and risk mitigation. Technology adoption for compliance and monitoring accelerates. AI, cybersecurity, content moderation, and reporting platforms experience growth due to regulatory demand. Stock valuations for these sectors rise while open expression platforms face decline. Global trade negotiations and investment decisions are influenced by speech restrictions. Multinational corporations evaluate operational risk, regulatory compliance, and reputational exposure. Stock markets reflect changing global strategies and capital allocation patterns. Corporate earnings projections face uncertainty. Restrictions on communication, innovation, and transparency introduce risk premiums, affecting valuation multiples. Stock markets adjust expectations sector by sector. Labor market psychology shifts. Employees prioritize compliance, risk avoidance, and secure sectors, reducing entrepreneurial activity. Stock valuations for workforce management, training, and compliance-related services increase. Consumer behavior evolves over time, prioritizing safety, predictability, and essential goods. Stock markets for consumer staples, utilities, and technology enabling compliance experience relative stability. Financial markets stabilize gradually as participants adapt. Sectoral divergence emerges, rewarding firms resilient to speech restrictions and penalizing high-risk, innovation-driven firms. Global investor strategies adapt. Allocation shifts toward essential services, compliance solutions, and low-risk sectors. Stock valuations for multinational corporations and financial institutions reflect these evolving strategies. Corporate innovation in non-regulated sectors continues cautiously, while high-risk, high-disruption industries contract. Stock markets respond to a slow-growth innovation environment. Policy intervention, judicial review, and public response influence medium-term corporate and market strategy. Stock markets remain sensitive to news, potential reforms, or legal challenges. Cultural and creative industries experience long-term contraction. Reduced freedom of expression limits product development, content creation, and consumer engagement. Stock markets for media, publishing, and entertainment reflect sustained risk. Investor behavior emphasizes defensive positioning. Capital allocation prioritizes stability, compliance, and predictable cash flows. Stock markets reward defensive and resilient sectors while innovation and discretionary sectors lag. The scenario illustrates how the suspension of free speech in the United States would profoundly reshape the economy. From labor markets and consumer behavior to corporate strategy, innovation, and stock market dynamics, the impacts are pervasive, multidimensional, and enduring. Stock markets reflect both immediate disruption and long-term structural adjustments, as firms and investors adapt to a fundamentally altered social and regulatory environment. Ultimately, eliminating free speech would redefine corporate strategy, innovation capacity, consumer behavior, and global investor perception. While the short-term effect may appear orderly, long-term economic growth, entrepreneurial activity, and market efficiency would face significant constraints, fundamentally altering the trajectory of the U.S. economy and stock market.